far, 2025 has been a good year for bonds. The All Bond Index has delivered 14% for the year to date and 14.5% over the last 12 months. Joining me today to discuss what lies ahead in bond markets is Fund Manager Duayne le Roux.
Hi Audrey, thanks for having me.
So Duayne, maybe you can explain to us why we've seen the recent rally in bond markets.
Yeah, great point to start, and yeah, thanks for having me. I'm sure as many listeners are keen to hear, it's been a phenomenal year in bonds again. So far, touch wood, yeah, as you mentioned, 14.5% over the last year seems like equity-like returns, and for that to happen 2 years in a row is quite exceptional. This year, though, the drivers have been quite different to, call it the year before, where it was quite politically driven. We saw a lot of the, we call it political premium being priced out of bonds. Coming into this year, we'll start with the fundamentals, which is looking really attractive. So we started in a position of really high real rates. Coupled with that, we also saw an environment where, as inflation came down, the SARB stood up and said, you know what, we're actually going to push for a lower inflation target. To the surprise of many investors, and also, I think, a welcome surprise as well. And they've proven time and time again their credibility. This is will be a bit of a different battle, but still, I think it bodes, and it has boded really well that in an environment where we've had high real rates, you know, bonds have performed well. That locally, coupled with, as we all aware of, you know, really credible rand strength, or call it dollar weakness, has painted a global backdrop for a very attractive environment for emerging market debt as a whole, not just in South Africa. We've seen that play out in countries like Brazil as well. So there's been a few factors, a few moving parts. We saw, although not in the beginning of the year, the kind of political settling down. You know, everyone has their views and their takes on how things should be run and should be performed. And of course, there's going to be the back and forths. But you know, at the start of the year, we saw a lot of call it birthing pains or growing pains as it pertains to the GNU. And as that's kind of settled down, we saw a lot of capital start to look favorably upon the developing situation that we have locally. And then lastly, I would just say that, you know, we've had this story in South African government bonds coming on from last year, really attractive returns. And it's starting to seem like foreigners are taking note as well. And this year, we've had record inflows over the year so far. And what's interesting to note is that although in absolute terms, those numbers are really large, in relative terms, foreigners have only had a marginal pickup in their relative ownership. So we've had a few drivers, some of them local, some of them global, very important, a lot of them fundamental, and that's important as well, and as we look into the future as well.
So Duayne, having seen this rally in bond markets recently, do you believe there is further scope for good returns from local bonds for our investors?
Yeah, it's a great question. We get asked this often. It's not very common that you see these year-on-year really significant double-digit returns. So if we look out from here on going forward, it's important to start with the fundamentals, and we think there is room for further strengthening on the back of those. Also with inflation being one of the key drivers, we saw inflation bottoming at 2.8% this year, which is incredibly low for an emerging market like ourselves. And at one stage, the expectations were that inflation would meaningfully pick up and we'd see a strong re-rating. And we think going forward, although I have seen the bottom and we are likely to see inflation moderate higher, chances are that expectations maybe set at the beginning of the year were a bit aggressive in terms of what that future path looks like, as well as the volatility around inflation, which is something not necessarily spoken about too much within an emerging market context. But as we try and endeavor towards a lower inflation target, it'll be incredibly valuable to have a lower inflation volatility print. And, you know, barring any supply side issues, we think there's room for that to continue. Furthermore, you know, we've seen material rand strength, but if we look at just the backdrop of, you know, a lot of pressure being put on the call it developed market currencies, and you know they've got a very different fiscal situations that they are trying to navigate. We think there's room for the rand to remain steady and potentially even stronger going forward. If we look at key drivers, and we've seen a strong terms of trade come through, and on the backdrop of really strong gold prices and a really strong PGM market, really being supportive of our local currency. Furthermore, we would love to see our reform agenda that's starting to show green shoots continuing to proliferate. We're starting to see early signs of that. Just last week, we saw how Transnet had some really welcome news with regards to the container terminal port that they were able to, hopefully we see further progress with regards to that legal struggles. And, that'll be material changes that we can start seeing coming, and obviously growth being the key number that we're all looking to see, moderate higher off a very low base. So yeah, there's fundamental drivers as well as, if we get the required policy stability, we think that there's room for further strengthening. We've seen material strengthening so far, so yeah, we'll have to see from here.
So do you think there are any risks that investors need to be aware of, especially when it comes to how everything comes together in their portfolios?
Yeah, incredibly important question, especially if we look at across the portfolio ranges, especially towards the lower risk end. It seems almost a distant memory now. You call it what we had is the Liberation Day volatility that we saw play out, as well as our budget for the first time, facing frictions as it was passed eventually. Seems almost a distant memory, but there are key risks still to watch and to monitor. I mentioned in the previous question just how important inflation and inflation stability is. I think we're really trying to keep a keen eye out for any kind of supply shocks that would look to threaten or destabilize that. It's welcome that we're seeing oil prices continuing to moderate lower, very welcome for an economy and even consumers as we are. But any kind of supply shocks would be incredibly damaging. Policy instability, we've had a period now where we've been able to enjoy just, of course, everything's not perfect, and we have our frictions as all economies do, but a period of policy stability, continuing to turn over in the right areas. Other key risks would be geopolitics is a massive one at the moment. We've seen this week again just heightened trade tensions between the US and China. These kind of things, we are a small economy, but we participate within the global economy, and those things tend to have ultimately ramifications for us. So any potential strong growth headwinds, I think, also are potentially damaging tailwinds that we're trying to navigate, and that our economy will need to navigate, and that we need to be aware of as well as investors.
So Duayne, for an investor looking to invest into the fixed income market at this point in time, selecting a fund or trying to find an additional investment for their portfolio, what should they bear in mind? And when it comes to the managers who are managing those funds, what should they be looking for?
Yeah, I think that probably touches to the heart of everyone listening is, and I would answer by saying, as an investor sitting on the other side, you get your return statement, you see what bonds have done and what the different sectors have done. It's important to also be aware to put those returns into context and reflect on actually what's my risk tolerance, what is the appropriate time frame that I'm looking at, and start with those key questions and then start to broaden out. We're very fortunate at PSG. We're able to service across the risk spectrum from our money market fund income, diversified income, all the way through to our higher risk or more aggressive funds in a balance and equity type funds that we've spoken about at length in previous videos as well. So we want to look for a manager that has experience in being able to manage across the risk spectrum, and with that experience, look for a process that's been tried and tested through not just good times, but times when they've also been challenged. And at PSG, as I mentioned, we've had the opportunity to do that across the risk spectrum, and also build out a process within the equity space, but as well as in the fixed income and multi-asset space that's been able to service those mandates really well. And on top of that, look for people that are able to you can back and you can trust. And we've tried to put ourselves and put our hands up as, you know, being, especially within the fixed income space where I operate, the safe pair of hands. Again, we understand clients wherever you are on the risk spectrum, especially if we think about at the front end, you're looking for stable, dependable returns with low levels of risk, safe pair of hands to see you through the good times, but also navigate the unsavory times for you. And that's something we've prided ourselves in being able to do, is really hold you by the hand and say, we're gonna get you through this period, and we're gonna do our best to make sure that you come out on the other end as expected and as promised from our side.
Duayne, thank you so much. That's a nice positive note to leave this conversation on.
Awesome. Thank you, Audrey, and thank you to everyone as well.